Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. We recently hosted our second client event of the year where we discussed the major market events and, more importantly, our thoughts on the economy and market as we move toward the end of 2014 and into 2015. We'll review and recap the main topics of that event today. Securities offered through LPL Financial, member FINRA SIPC, investment advice offered through Texas Legacy Wealth Management, a registered investment advisor and separate entity from LPL Financial. Our theme for the event was what matters most. What matters most for us is you, your goals, your objectives, your life, your family. We aim to shoulder the financial burden so that you can focus on what matters most in your life. Knowing one person can't do it all, regardless of how good they are, we've built our firm on a foundation of teamwork. Each member of our team is empowered to use his or her expertise to benefit our clients, whether through communication, investment decision-making, financial planning, or service. We're committed to bringing communication and commentary to you through your preferred medium. For those that prefer to use social media, we hope you'll ask us questions by using the AskTLWM hashtag. During the recent client event, we asked clients to tell us what's on their mind. The three biggest concerns that clients expressed to us were stock valuations, the economy's recovery, and geopolitical events. We'll spend a little time addressing each of those. But before we jump into these major topics, let's briefly get an update on the market returns for the year thus far. August was a great month for stocks as the S&P 500 notched an almost 4% gain as the index closed the month over 2,000, a major psychological level. This brought the S&P's total return to almost 10% for 2014. With such a strong move, stock market valuations once again come into question, with the 12-month forward PE currently above the 5- and 10-year average. With that said, stock market valuation is a poor market timing indicator. While of paramount importance to investment returns over the long term, there is no relationship between price-to-earnings ratio or what investors are willing to pay today per dollar of earnings over the past 4 quarters and stock market performance over the following year. However, the PE can tell you when the market has become fully valued and is more vulnerable to any deterioration in the economic cycle. The higher the PE, the brighter the implied outlook for future earnings growth, and the greater the disappointment if that growth does not develop. The current PE of just under 17 is above the long-term average since 1927 of about 15. While this is above average, it is far from the peak of 2000. Nevertheless, it's approaching an important range. Since World War II, every bull market has ended with a PE of 17 to 18, with the exception of the bull market that ended in 2000, which peaked much higher. However, we note that within a very low interest rate environment, we believe PEs can be extended for a period of time. The concerns around economic growth came into focus earlier this year with the truly awful first quarter GDP number. In fact, before upward revisions, Q1 GDP looked to be the 17th worst quarter in economic history. Harsh weather coincided with this poor quarter of economic growth, and that was no coincidence, as we saw the coldest January in 25 years. In fact, the first quarter of a year is particularly sensitive to weather conditions. The poor growth in Q1 was made up for by better than expected second quarter GDP growth of 4%, and future economic growth is projected to be positive as we move toward the end of 2014. This is not the case in Europe, as the Eurozone continues to struggle with stagnant growth and very low inflation. It will be important to watch the ECB's policy adjustments as they try to stimulate economic growth and jumpstart the European economy. In terms of geopolitical risk, turmoil has hit many areas of the globe so far in 2014, disrupting the financial markets for weeks at a time. Perhaps the most severe example is the ISIS organization that has moved throughout Iraq and Syria, disrupting the existing government. This particular instance has roiled the global price of oil and has raised eyebrows due to the U.S. government's recent history with this region. This, along with the Russia-Ukraine conflict, has kept markets on their toes, but we have yet to see any major global economic impact at this time. The Great Recession ended about 5 years ago, and the question now becomes, where are we in the economic cycle? If we were to think of the economic cycle as a baseball game, we feel we'd be in the 7th inning. We're certainly not at the beginning of a growth cycle, but feel that we have some time for the cycle to continue, and we could potentially even see extra innings. As we look at each stage of the economic cycle, we feel we're in the middle stage. As the economy matures, we see the following characteristics: moderate GDP growth, a slow return of inflation, and the Fed is beginning to normalize policy as they taper and think about raising rates next year. The question on the lips of many investors is, how will we know when we move from the maturing growth stage to one where the economy begins slowing and potentially heads back into recession? We like to look at 5 key indicators that have consistently stood the test of time and reliably signaled the increasing fragility of the economy in a transition to the late stage of the cycle and an oncoming recession. The market fundamental valuation, technical and sentiment indicators are each important. Of the 5, only valuation appears to be elevated above a comfortable level. Therefore, we believe the market is due for a pullback, not a recession. We would equate this to the 7th inning stretch of a baseball game. It's not the end of the game, but merely a short break before the game resumes. Sometimes great games go into extra innings. With the majority of these indicators still positive, we believe the economy has more room to expand over the long term, which could justify higher prices for equities. We will continue to keep a close eye on each of these indicators on an ongoing basis. If we feel like we're beginning to get to the later stages of the cycle and warning signs are flashing red, we're willing and ready to make changes if we feel there's a heightened level of risk in the market. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We would also like to remind you to follow us on Twitter and like us on Facebook. Thank you.